Part 1 of the financial statements, the income statement and statement of retained earnings. When financial statements are presented, GAAP requires that 4 be prepared. They are the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. The financial statements are prepared in a certain order and they relate to one another. This diagram shows how accounting data flows from one financial statement to the next. The order is important. The income statement is first, followed by the statement of retained earnings, the balance sheet, and finally, the statement of cash flows. The income statement, or statement of operations, measures operating performance by reporting revenues, which are also referred to as sales, and gains, along with the expenses and losses for the period. The bottom line is net income or net loss for the period, depending on whether revenues exceed expenses or expenses exceed revenues. In accounting, the word net refers to an amount after a subtraction. Net income is the profit left over after subtracting expenses and losses from revenues and gains. Net income is the single most important item on the financial statements. In summary, net income is the total revenues and gains minus total expenses and losses. As an example, let's take a look at the Walt Disney Company's income statement. Although the heading on this report is not what you'll see in your homework, notice that the first line contains the company name, the Walt Disney Company. On the second line is the term Consolidated Statements of Income. The Walt Disney Company, which I'll just refer to as Disney, is actually made up of several corporations that are owned by a common group of shareholders. Commonly controlled corporations like this are required to combine or consolidate all of their revenues, expenses, assets, liabilities, and stockholders' equity, and to report them all as one. The dates of Disney's consolidated statements of income are 12 months ended September 27th of 2014 and 12 months ended September 28th, 2013. Unless a company has just finished its first year, they will provide 2 or more years' worth of data for comparison purposes. Disney, like many retailers, uses a fiscal year consisting of the 52 weeks ending closest to September 30th as the accounting year. This is because the summer is the busiest time of the year for Disney, while September is typically a slower month, allowing the company time to get its books in order. Companies often adopt a fiscal year that ends at the low point in their operations. Disney's consolidated statements of income have 2 main categories, revenues and expenses. They separate out their service revenue from their product revenue and their cost of services and products. In a later chapter, we will refer to these as cost of goods sold. Overall, in fiscal year ended September 27, 2014, Disney earned total revenues of $48,813 million, which is line 5, and had total expenses of $37,273 million, which is line 10, and total net income of $7,501 million, which is line 17. Keep in mind that this is an extremely simplified version of Disney's income statement for illustration purposes. The second financial statement is the statement of retained earnings. It shows the changes in retained earnings from the beginning to the end of the period and explains what the company did with its net income. Retained earnings means exactly what the term implies, which is that portion of net income the company has kept over a period of years. If historically revenues exceed expenses, the result will be a positive balance in retained earnings. On the other hand, if historically expenses have exceeded sales revenues, the accumulation of those losses will result in an accumulated deficit in retained earnings, usually shown in parentheses. Net income increases retained earnings, and net losses and dividends decrease retained earnings. A positive balance in retained earnings indicates that a corporation has been able to accumulate earnings over its lifetime in order to expand, as well as to return a portion of its assets in the form of dividends to shareholders if the corporation distributes dividends. After a company earns net income, the board of directors decides whether to pay a dividend to the stockholders. Corporations are not obligated to pay dividends unless their board of directors decide to pay them or declare them. As an example, here's Disney's consolidated statement of retained earnings for the 2 years ended September 27, 2014. Notice that the time period covered by this report is the same that is covered by the income statement. The period began with the beginning balance. Net income, which we saw on the income statement, was added, and dividends and other reductions were subtracted to arrive at an ending balance for September 2013. For 2014, net income was again added, and dividends were subtracted to arrive at the ending balance for September 2014. This ending balance will now flow to the next financial statement, the balance sheet, which will be discussed in the next video.